Hello, everyone. My name is Daharsh. I am here today from Advanta IRA with special guest Suja Shyam to bring you the math behind the money. We're going to be reviewing syndication investing, and Suja is going to cover on a high level some really great information about syndication investing and where your dollars actually go towards and how these types of investments are worthwhile and very valuable to retirement account investors as well as other investors alike. Again, our names are Daharsh. I've been with Advanta IRA since 2016. I spent a lot of time as a client account manager processing day-to-day transactions for investors. But in 2020, I actually made a transition to join the business development team, where I now educate and network on self-directed investing throughout Western North Carolina, some parts of Tennessee, as well as South Carolina. And our guest today is Suja Shyam. She is the principal at Luxe Capital. She also hosts a passive investing podcast called Passive Income Unlocked Podcast. I've got her contact information here, as well as a link to her podcast if you'd like to learn more. Suja, thank you very much for joining me today. I'm very excited for the content we're going to bring to the audience.
Thanks, Corey. Really happy to be here. And thanks everyone for joining. We're going to have a really fun time learning about syndications.
And just so everyone's aware, you will be muted for the duration of today's presentation, but we do want to have some active participation. So if you look at your GoToWebinar panel, there should be a box there labeled questions. You can use that box to type in any questions you have for us as we go. And I believe Suja also wants to engage you with some other questions just to make sure everyone's participating and feels like they're part of today's session. So please do not shy away from that question box. Also, if you're interested in receiving a copy of today's slide deck, I've got that already dropped into the handouts portion, or you could reach out to either Suja or myself after the fact with our contact information if you'd like a copy of the slide deck. So just making sure that that housekeeping is out of the way, and we're going to go ahead and get started. I'm going to cover some basic information about retirement investing, and then Suja is going to take over for the actual high-level syndication investing materials and information as well.
Okay, awesome. So I guess just to get everyone started, I mean, before Corey dives in, I just wanted to hear a little bit about who's in the room. You know, this is supposed to be fun, and the more fun we have, the more money we're all going to make. And so I just wanted people to drop into the chat or the question box their name and what they're drinking. I myself have a black tea and a coffee. I'm on the West Coast here in Portland. So just drop into the chat what your name is and what you're drinking.
And I am drinking just a nice ice water right now to get me through the midday. I've already had my coffee for the morning. I'm in Eastern time zone, so it's right about noon for me. So I'm sure there's people from all over the country that'll have some insight as to what time they're in, what they're doing, or where they're at. It looks like Carol is drinking flavored water. All right, so just jumping back in, today's agenda, I'm going to cover who Advanta is and what self-directed retirement accounts offer you, why people choose to start self-directing, and a brief case study on how easy it is to use a self-directed account to make a syndication investment. And once I wrap up that case study, I'm going to turn it over to Suja for her portion of the presentation, which is really where we're going to cover the math behind the money and jump into some really interesting and very helpful things for you as potential syndication investors. And then we'll have an actual Q&A session at the end as a conclusion. If we haven't answered your questions throughout the presentation, again, please type them into that same question box people are using now. I see some people drinking water, someone's drinking a protein shake and an ice water. Double fist in there, the good old double fist.
Awesome, love it.
So the thing I want everyone to take away with from this presentation is that you should always conduct your own due diligence thoroughly. With self-direction, you're ultimately in control and no one's overseeing or signing off on the investments you make. So it's very important that you do your due diligence, consult with your CPA, tax preparer, financial advisor, and you're comfortable before entering any investment. Another key takeaway point is that your retirement account is the investor, not yourself individually. So all of the tax liability and tax shelter in this case flows directly through your retirement account and not through your personal name and or social security number. And the third thing is that syndication investing, specifically as a limited partner, which we're going to talk about today, creates completely passive income, also commonly known as mailbox money. So these are investment strategies where you may have a holding pattern where you give your money to a general partner or a syndicator with an expectation of about a 5-year hold, sometimes is average. You may receive income dividends within those 5 years, and then typically a payout at the end of the 5 years, returning your initial capital invested, plus ideally some additional gains and profits on the back end of that full cycle syndication transaction. So those are the key takeaway points that I think everyone, if you're paying attention, will learn today. And I just want to make sure they're outlined specifically for you as well. So Advanta IRA is a company. We're in our 20th year of existence this year. We'll be celebrating that 20-year anniversary later this year. We've been around for about that long. As of now, we've got about 10,000 active clients with just over $2 billion in assets under management. All of our clients' funds that are not actively invested are insured up to FDIC limits. And one other thing, aside from these free educational webinars and our own podcast that we put out there to stand above and beyond other competitors in our space, is we pair each client with a dedicated client account manager, that role that I referenced I served for a number of years, so that you just have one point of contact on our team that you go to whenever you have questions, whenever you have a new investment you'd like to fund. You're not calling a call center and dealing with who knows every time you reach out and try to get something done with your self-directed account. If you have not heard about self-directed retirement investing, that's okay, and it's actually pretty common. Not a lot of people know that this exists because those larger wirehouse custodians that actually serve as a fiduciary to you prefer not to let you know that self-directed is an option, so that they can keep your dollars under their guidance or tutelage and charge you for a fiduciary capacity, whether it's a flat rate or a percentage of the investments that they put you into. So only about 4% of the US retirement accounts are currently being self-directed. And to put that into perspective, across IRAs, 401ks, other types of retirement accounts that the US offers, there's about 37 to 39 trillion with a T, trillion dollars in total in these tax sheltered options. So only about 4% of those, roughly 1.5 trillion, is currently being self-directed. So we always try to expand education and knowledge so that people, whether they are interested in taking advantage of this or not, know a little bit more and know that the option is out there. At Advanta, we have a great learning center, so we always offer free education like this webinar here today. You can find the recordings of these webinars on our YouTube channel. If you're in our local areas where we have offices, which is Largo, Florida, or basically the greater Tampa area, or Atlanta, and myself in Western North Carolina, you may catch one of our in-person events like a lunch and learn or a different in-person event we're hosting. And we also have a podcast called the Alternative Investing Advantage podcast, hosted by my colleague Alex Perney, if you're interested in some specific high-level information and knowledge about self-directed investing. We always try to bring on expert guests, and we try to field these by what the audience is actually interested in. So if you're checking out these content and you have a topic or a subject that you want to see us cover, or even a guest speaker that you would like to see us work together with, please feel free to reach out and let me know, and I'd be happy to work on getting that put together. The other event that Advanta IRA offers is called Pitch, Promote, and Prosper. This event is every other Friday, and it's an investor networking forum. We cannot endorse any specific opportunities or products you may hear about, but this call called Pitch, Promote, Prosper is the session that we have where anyone can sign in. It does not have to be a client of ours. It does not have to be a retirement account investor, but everyone on the call gets a chance to give their elevator pitch to the rest of the call and say either what they're looking for or what they have to offer as an investment opportunity. So if those of you out there are either looking for your next deal or have a deal to offer and are looking to capital raise, feel free to check us out, Pitch, Promote, Prosper. We did host last week, so the next session will be February 10th, 12 noon Eastern to about 1:30, depending on how large the participation is. And these are people from all across the country that sign in. We even sometimes have people internationally that sign in to promote their deals or look for deals that they may want to take down with their retirement dollars or sometimes their own savings dollars as well. So there are a number of type of self-directed plans that can hold alternative investments. A lot of you are probably familiar with your standard traditional and Roth IRAs, but for small business owners, those that have no W-2 wage earners, we also offer SEP, simple, and solo 401k plans, as well as health savings and education savings accounts. So those are all the types of plans that we offer, and you can self-direct through any of them. If you're someone that has a previous employer 401k, 403b, or 457 plan, those are great retirement dollars to start self-directing. You're typically not earning too much once you leave an employer, and that money is sitting idle until you actually direct it into another investment strategy. So keep an eye on that. If you've left an employer, reach out to that plan custodian and see if that money's still earning for you at all. And if not, maybe it's a great time to consider switching into a self-directed investing strategy. Why do people choose to self-direct? Well, first off, they hear about this even being an option and decide, hey, the tax benefit of using my retirement money into a real estate investment is much better than leaving it in a CD or a money market account. And I'm actually generating better returns than stocks, bonds, and mutual funds by controlling through self-direction. And again, when you're making these investments with your retirement dollars, your income is growing completely tax-free. You either pay taxes in a deferred capacity later on when you distribute the money out of your account, and that is paid at your ordinary earned income tax rate. Or if you're making these investments through Roth IRA or Roth component 401ks, then you do not ever have to pay taxes on the income generated by the investments you're making. And again, if you're already a real estate investor and just learned that you can tap into this money, it's a new source of capital. Maybe you're already working with capital raisers and looking to join a syndication and find out, oh, I can invest with my personal money into this syndication and also make a separate investment with my retirement dollars. If I really like the prospectus on this deal and really think it's going to pan out well, I may want to diversify and put more money into this deal that I have available now that I know I can self-direct my retirement. So again, why are 401ks and IRAs a good source of capital? It's very easy to repeat invest with the syndicator. A lot of times, once you roll out of a syndication deal, if it panned out the best way you expected it to and that syndicator or general partner did a great job, you may keep your money with them and roll into the next deal they have to offer. If you do not expect to use your money anytime soon, again, that's a great option, because a lot of these syndication deals are either 5 or 10-year hold patterns. They're usually something that's outlined by the syndicator at the onset, so you know how long to expect your money to be tied up in the investment. And sometimes they even pay out a bit early if that investment runs full cycle faster than it initially was planned to, just because the syndication group is able to drive better returns at an early exit strategy. And again, there's no outside approval needed. So no one besides yourself as the self-directed account holder decides what you do or do not invest into. The IRS's rules and regulations are very simple as to what you can and cannot invest into. Basically, you're not allowed to hold life insurance policies or hard to value collectibles like antiques and fine wine and artwork, but anything else you may want to hold with your retirement dollars, you are allowed to. So no outside approval. Advanta, as a self-direct administrator, simply helps you follow what the IRS rules and regulations are and lets you make the decisions of your retirement dollars. It's very important to invest within your network and understand that triad of know, like, and trust as you're finding deals. So check out our networking forum, check out your local RIA group or your local syndicators group, wherever you may be located, to learn and get better connected within the investing industry and investing network to find your next deals. As I alluded to earlier, just a brief disclaimer, all the information here today is for educational purposes only. Advanta IRA does not provide any tax, legal, or financial advice. We do have partners in those fields. If you're interested in getting advice or counsel, we can point you in the right direction of some experts, but otherwise it's completely up to you to facilitate your own experts for your guidance and due diligence. And the final few slides for me here are my case study on making a syndication investment. So I've got this case study with an individual named Larry who has about 50,000. I've got an individual named Larry who has about $50,000 in a retirement account over with a managed custodian. And he meets Malcolm, who's a syndicator that's got a local apartment building that he's trying to raise capital for. So Malcolm and Larry have a meeting. They go over the investment paperwork and the prospectus, and Malcolm basically provides all the details to Larry. Larry decides he does want to make the investment at the $50,000 minimum threshold. So Larry sets up a self-directed account. It's very simple to move money from his existing plan to his self-directed plan. That's typically facilitated all within about 1 week's time frame. And once he does that, he also coordinates with his account manager to get the paperwork over, executed in the name of the retirement account and tied through the retirement account's tax ID number, not Larry's personal social. Once he's approved all the paperwork, we execute the transaction and send the funds out to Malcolm's team, and the syndication investment's placed. Moving forward, and these are just rounded numbers, for example, I know Suja will cover some more realistic numbers and realistic examples in her portion of the presentation. Moving forward, the syndication group pays 8% preferred distributions to all subscribers. That's $4,000 generated per year. In the 5th year, the project's refinanced and the retirement account receives a lump sum payout of $65,000. So over the course of 5 years, that retirement account had generated $35,000 in total of profit on top of returning that $50,000 initial investment. Keep in mind that can either be tax deferred money that's paid later on when he distributes it out of his retirement account, or if it's a Roth investment, that was completely tax-free income that's been generated that will never have to be paid against taxes in the future at all. And that can be reinvested into any asset class or any other syndications that Larry and Malcolm may decide to participate in together moving forward. So, what type of investor are you? While all of these retirement strategies are expected to be passive income strategies, there are some real estate investments that are a bit more active, like actually holding physical real estate or doing a fix and flip. Those are things you can do with your retirement account, but more of an active role. And it may be in your best interest, if that's the type of investor you are, to consider those strategies. But if you are a truly passive investor and you are interested in that mailbox money where someone else is handling the day-to-day operations of the real estate project, then syndication investing is probably your best option. Again, you are putting up your money, you're making sure you trust the investment provider and you've done your due diligence, and then you receive returns and income generated by that general partnership team that fuel the investment moving forward. So as my final tidbit here from my side of things, it's very easy to get a self-directed account started. It takes most people about 10 to 15 minutes to complete our application. They'll get their account funded and ready to invest within about 10 to 14 days, conservatively speaking. And once your account's open and funded and you're ready to then start making any investments that you find that you want to bring to the table, you just coordinate with your client account manager and they'll help you get the deal done as simply and efficiently as possible. So that is my portion of the presentation. Give me one moment. I'm going to go ahead and flip my screen over to Suja's presentation, and I will let her take over from there. Suja, while I'm flipping that over, do you have any other questions or any other feedback you'd like to grab from the audience?
Yeah, no, I think that was a great overview. Thank you, Corey. And just for those of you who are just joining, my name's Suja, and I'm excited to be talking with you today about syndications and about really how they work. You know, in terms of the educational aspect, getting comfortable with how the deals work is really really important, because no one should invest in something that they don't understand. And there is a little bit of a learning curve to investing in syndications. So that's why we're here today. And yeah, so to get started, you can flip to the next slide, Corey. So just what we're going to go over today, we're going to talk about just a brief introduction on me, and then why investors are diversifying into apartments and other similar types of deals. You know, there's multiple asset classes that are in real estate syndications, but we're going to focus on apartments today. And then we're going to talk about how apartments actually make money. So how is it that these deals can create such outsized returns? We're going to go over some of the important terms and what they mean at a relatively high level, but it'll be a good start for those of you who this is new to, and for those of you who have learned about, you know, what a cap rate is and some other lingo. Hopefully you'll learn something new as well. And then we're going to talk about what happens when you start investing $50,000 a year. And I have a calculator that I want to show you. So yeah, with that, let's go to the next slide. So just a brief introduction on me. I'm Suja Shyam. I was born in San Francisco area, and I have been in real estate for the last 13, 14 years. I started out working for large institutional investors, meaning banks. So I would underwrite deals for banks, and by deals I mean multifamily apartments. So have been in multifamily really for the last 12 years. But I didn't really enjoy being in the corporate environment, and I wanted more control over my time. And I just knew that going to an office for me for the next 30 years of my life, it just wasn't how I wanted to live my life. And so I ended up becoming a real estate investor, and I grew my portfolio. I started out with just a little house that I purchased for $20,000 using my student loans. And then I kind of took a break. So that's the thing about real estate is I started, but then I stopped, and then I was just kind of in the grind working, and I didn't do anything for a couple of years, and I lost the momentum. You know, I got it back, but I think that's a really key point that anybody should think about when they're growing their wealth and trying to make real change, is that you got to be consistent and you got to keep going. So I lost some time, but eventually I started up with my real estate career again. I started out with a house hack, which you may or may not know what that term is, but if you don't, it's basically when you buy your first house and you rent out parts of it, either the basement or the other side of the duplex, and other people end up paying your mortgage. So I did that, and so I had a cash flowing property for my first house. And then eventually I built a short-term rental portfolio, and that allowed me to replace my corporate income working for banks. So by short-term rental portfolio, that's kind of like Airbnbs or vacation rentals. And that's a whole long story, which I'm not going to go into right now, but that is how I replaced my income. And then I realized that I wanted more passive income. I wanted to invest intelligently because I was generating all this cash from my short-term rental portfolio. But what do I want to do with it? I didn't want to put it in the stock market personally. You know, that's a sort of personal decision. If you're here, you probably don't want to put all of your money in the stock market either. So that's when I turned back to syndications, because what I had been doing for the institutions was actually investing in syndications, but the investors were other banks and pension funds and life insurance companies. I didn't know that this business model was available to the individual investor. So I went to syndications. I realized people were doing this, and that's how I got back into syndications. And it's something that I'm just very passionate about sharing with people, because I think it's one of the best ways to build wealth on a risk-adjusted basis. And I love helping people gain financial peace of mind. And that's really what this is about, is knowing that you're growing your wealth in a sustainable way that allows you to sleep well at night. Okay, next slide. Okay, I'd love for everyone to take a quick snapshot of this slide so that if you do have to drop off early, you can still get in touch with me. We're going to go over a calculator today that will allow you to take a look at what would happen to your wealth if you did invest X amount of money every year. And if you want that calculator, just go ahead and email me. And then if you want to grab time on my calendar, that QR code will link to my calendar. And so just grab a snapshot of that, and we'll go to the next slide in a second. Okay, thank you. So just a few pictures so you kind of know who I am. I've got a partner. My family is based in the Bay Area, and I love spending time with my nephews and nieces. Those are some pictures of my parents. I love to travel and roller skate. So that picture in the bottom right is a kayak trip in the bottom of Baja. And I'm actually doing that trip again this year because it was just so wonderful. So that's a little about me. And next slide. Okay, so let's talk about why apartments. You know, like I said before, if you're here, you probably are interested in not having all of your money in all of your retirement in the stock market. So apartments are recession resistant. Why is that? Because when the economy goes down and when people start losing their jobs, oftentimes they can no longer afford to live in the places that they were living. They need to downsize their lifestyle. And so they'll move from a single family home into an apartment, or from a more expensive apartment into a less expensive apartment, to save on costs and try to help them get through a period where they may not have the same income or they may not have a job. And so apartments are somewhere where people move into during a recession. But also with apartments, there's also different types of apartments. There's Class A apartments, which are the luxury apartments. There's Class B, which are pretty nice. And then there's Class C, which is, you know, kind of your average apartment, not that nice. And then there's Class D, which is kind of dangerous apartments where you might not, where there's a high incidence of crime and vacancy. And so during economic positive times, when the economy is growing, people will also move up. They'll move from a Class C to a Class B, or a Class D to a Class C. So if you can be in that Class B, Class C of apartments, then you're going to be able to capture tenants who are either moving up or down based on whatever phase of the economy is going on. You know, we also get rewarding returns, and that's what we're going to go over here. How do we project to double people's money in 5 years? That's usually what we're projecting. You know, you'll see numbers along those lines in most deals that you look at. And how do we actually create those 20% average annual returns? Again, everything's a projection, but that is oftentimes what you'll see in the projections. With apartments, you also have the ability to buy back your time. You know, we're talking about retirement account investing here, but if you are investing with your personal money, then you're going to get passive income. And that's something that builds over time. So it kind of feels like a trickle at first, but if you have big goals, like if you want to start putting, if you want to start getting into the $1, $2, $3 million of investments into apartments, then you can really replace your income and buy back your time. And lastly, it's the tax benefits. So real estate is very tax advantaged, and it means that you can grow your wealth more effectively. Okay, next slide. Okay, so as I mentioned, we're usually looking to double investors' money in about 5 years, maybe sometimes 6 years. So that equates to about a 20% average annual return. And that includes both cash flow. So the deals, as Corey mentioned, are usually 5 years. You know, I would say 3 to 7 years is pretty typical. And you're going to receive cash flow during that time. And during that time, we're going to renovate the property and increase rents, increase the efficiency of the property, meaning decrease expenses and improve the net operating income, which is income minus expenses. And so by doing this, we increase the value of the property. And that's what we're going to go over today is what is the analysis behind that? How do you actually measure what the value that you're creating is? And because we're increasing the value, we can then sell the apartment for quite a bit more than we purchased it for. And so at the end of the investment period, you'll get a big chunk of money back as well. So today we're going to cover how does the money flow. Next slide, please. Okay, here is just an example return. This is something like what you might see in a typical syndication investment. I like to cover this at the beginning because people usually want to know, well, what kind of returns am I going to get? So if this was a $100,000 investment, you might see in year one a 10% cash on cash return. You might see less. It depends on the deal. So there's certain deals that have higher cash on cash return in the beginning, or there's certain deals that have lower cash on cash returns. But just as an example, you might see a 10.5% return in year one, an 11.5% return in year two, which equates to $10,000 or so in year one, $11,000 or so in year two. In year three, perhaps we'll be able to refinance, in which case you'll get a big chunk of your capital back in addition to the cash flow. And with that, you could make another investment in year three in a different property if you so chose. And then in year four and year five, you might see 9%. The fluctuation in cash flow, it depends on how the deal is structured. So I won't get into the details about that right now, but the cash flow will typically fluctuate, and it will typically go up and then kind of level off after the first few years. So then, as I spoke about before, we're going to have increased the value of the property by quite a bit, and we'll be able to sell it for, we'll look for the opportune time to sell in the market. So that's one of the things to keep in mind as an investor, is that you don't necessarily know when the opportune time to sell is going to be. We make projections 3 years, 5 years, 7 years, but really we need to wait until an opportune time to sell. So when that time does happen, then we'll sell, and you'll get another big chunk of money. In this case, the example is just an example, is another $50,000 at that time. And so the total that you receive back is about $200,000, which is about doubling your money in 5 years. Okay, next slide. Okay, so it's really this session is about helping you understand how we create this kind of value, because they are pretty outstanding returns. And it's important to know, well, how do you actually do that, right? Like, how do you outperform the market? So some terms that we're going to cover are cap rate. So, and then we're going to go over what a sponsor is, and a general partner, and an operator, and the limited partner. So in this example, you all would be the limited partners. You are passive investors. You are silent partners. You're folks who are putting your money in, but you don't have any responsibility for the deal except for just putting your money in. The sponsor, the general partner, and the operator, that is the team that is responsible for finding good deals. So finding a good deal is really important, because not every deal is something that we want to buy, right? Like, we need to find a good deal. We need to know that we can add value to that property. We need to know what the business plan is going to be and have confidence that we can execute it. We need to put money together, like gather the money to buy a 100-unit complex or a 300-unit complex. And then we need to be able to sign on a loan, right? Like, being able to get a loan, that requires, it can be done in several different ways, but not just anybody can go get, a $10 million loan or even a $50 million loan. So the sponsor team is responsible for finding the deal, buying the deal, negotiating it, executing the business plan, managing the asset, optimizing it, and they also bear all the liability. So the limited partners, the passive investors, don't have any liability, and they're limited liability partners, whereas the sponsor takes on the liability. Okay, so let's go to the next slide.
And Suja, as we're kind of covering this, I did want to just ask you to outline a little bit further. When you're looking at that general partnership team or sponsor team, it's typically built up of people with varying expertises. So you mentioned earlier you had a background in underwriting. So you may be the underwriting person on your team, but there's also going to be maybe an investor relations person and a capital raising person that all kind of pool their certain expertises together. So all of the weight of putting this deal together are not on one specific person. Do you want to speak to that a little bit further as well?
Yeah, that's a really good point. So as Corey mentioned, there's often a team that consists of the sponsorship team. And that team, I like to say that syndication and apartment investing is really kind of 6 business lines or something along those lines, because there's many expertises that are needed. You need to have that acquisitions team. The acquisitions team are the folks that have a relationships with the brokers, and they are ear to the ground. They know exactly what's happening in the market, what apartments are renting for, what kinds of concessions are being given or not given, what tenants are paying for. Are they paying for valet trash? Are they paying for reserved parking? So that they can identify opportunities to purchase properties. So the acquisitions team is just like an entire business line of itself. And then you've got the capital team. So how are we going to get the money to put this deal together? So the capital team usually involves investor relations, because every deal has a debt portion, which is the big loan that you get. Think about when you're going to buy a house, you get a loan from the mortgage and then you put a down payment down. So the capital team has to get a loan, which is a big task, finding that right lending partner and qualifying for the loan. And then they've got to raise the equity portion, which is what the limited partners contribute, which is equivalent to the down payment if you are purchasing your house. So every real estate transaction, we've got to have the down payment and a loan. And the capital team, they are finding the equity because they have expertise in running these deals, but there is always a need for capital in order to make the deals happen. So there's a capital team. Then there's the operations team. The operations team handles improving the property. So oftentimes how the property improvement works is there's, so let's say it's a 100-unit complex. When somebody moves out, then that will be a great opportunity to rehab that apartment. And the operations team is going to have those relationships with contractors. They're going to know, okay, well, this is what we want to do to this apartment. This is how much money we should be spending on this apartment. Because you don't want to overspend. There's no point in making a super fancy unit if the rents in the area aren't going to support that. So they decide what they're going to do, and then they execute that, right? Because vacancy is a major problem. So we want to minimize the amount of vacancy that we have, and so executing the renovations in a efficient manner is important. So there's the operations team. The operations team is also in charge of the property management. So making sure that tenants are paying, making sure that we have a waiting list or are able to quickly lease up units as they become available, making sure that the residents are happy, meaning like potentially doing community events and making sure that everything is attended to in the property from a management perspective. Are there landscaping issues? Are there water intrusion issues? Just maintaining the asset is a huge task in and of itself. So, and then there's the disposition team. So the disposition team is in charge of selling the asset. So that's like a whole nother process. We've got to know, well, when is the opportune time to sell the asset, and who are we going to sell it to, and how are we going to get the best deal? So there's several different components, and that's what the general partnership team is responsible for. And that's why, I also am a passive investor, and I just love that I get to rely on the expertise of so many different sponsorship teams through syndication investing.
Awesome. Well, thank you very much for breaking that down a little bit further for our audience. I'll jump into the cap rate slide here. And just a friendly reminder to the audience, if you have questions as Suja's going through, please feel free to drop those into the question box, and I'll be happy to ask her, and we'll get those facilitated either as we go or even a Q&A session at the end as well.
Yes, just to reiterate that I really want this to be, I want to answer your questions as they come in, if they're relevant to what we're talking about. So Corey's going to bring those questions to me, and would love to hear your thoughts or if anything's coming up, because math can be kind of confusing for some folks. And so, you know, happy to take, this is the perfect opportunity to take the time to make sure that everyone's really getting these concepts. Okay, so cap rate. This is, you know, this is not the easiest term to start with, but we've already kind of done a basic overview of what syndication investing is. So what is a cap rate and why does it matter? So a cap rate represents how much a buyer is willing to pay for an income stream. So let's say a property produces $100,000 in cash flow each year, meaning let's say there's $200,000 of rent that's collected and $100,000 of expenses, meaning utilities and property taxes and insurance and maintenance and repairs. So that leaves $100,000. And you know, notice I didn't mention mortgage. So mortgage isn't actually included in net operating income. And that's because there's different types of buyers out there. There's some buyers who are going to pay all cash for a property, and there's some buyers who are going to get a loan. People are going to qualify for different types of loans or choose different types of loans. And so we need to be able to compare apples to apples. And that's why I haven't included the loan payment in this calculation. So a 5% cap rate is a typical, you know, it's a typical cap rate. We'll talk in just a second about why cap rates might be higher or lower. But at a 5% cap rate, and I'd like for everyone to pull out their calculators on their phones, just take a moment and type in $100,000 and divide that by 0.05. So that equals $2 million. And, you know, obviously that's written out on the slide, but I just want everyone to have their calculators available and do this with me, because that'll help build the muscle for you to understand how these numbers work. So if a property is producing $100,000 in cash flow, then at a 5% cap rate, the property is worth $2 million. So you could expect to be able to sell that property for $2 million. So this is how operators try to get an idea of when to sell. They look at what the going cap rate is in the market. So cap rates shift with the economy. When the economy is getting better, cap rates are going to go down. So let's actually try $100,000, just type that in, $100,000 divided by 0.04. So that means the cap rate's going down, it's going down to 4%. So what do we get? We get $2.5 million. So when the cap rate went down, as the economy was improving, then the property was worth more. And why is that? It's because people have more confidence in the economy, and they're just willing to pay more for the same income stream. If the economy was to get worse, now just take $100,000 and divide that by 0.06. Okay, so what do you get? You get $1.67 million. So if the economy got worse and the cap rate in the market is now 6%, then you could only sell this property for $1.67 million. So those swings of 1% are really large swings. Oftentimes cap rates swing by 0.1% or 0.2%. So they move pretty slowly. As you know, real estate moves more slowly than apartment buildings. So those were kind of extreme examples, but just to illustrate for you all how a cap rate can change the value of a property. So what kinds of things can make the cap rate go up and down? So if an area is becoming more popular to move to, for example, the Phoenix market, it saw very significant cap rate compression over the last several years. And that's because it was still an affordable city and a lot of people were moving there due to jobs and quality of life. So cap rates really went down in Phoenix. Cap rates tend to be lower in large cities like San Francisco and LA and New York. You tend to have very low cap rates there, which means that there's a little bit less opportunity to really create value. So a lot of times syndicators are going to what we call tertiary markets or emerging markets. These are markets that are less established. They're usually more affordable, and we're usually trying to select markets where there is strong job growth and strong population growth so that we can buy apartments at a higher cap rate and then improve the operations and still do very well. So let's go to the next slide.
Well, Suja, there's actually 2 cap rate related questions that came in if you want to cover those first.
Absolutely, sure. Yeah. We're
So
going to
the
be
first one,
a bit. So yeah, go ahead.
the first one reads, don't I want a higher cap rate? That means I'm making more money, I thought. I'm confused. So that's the first question, and then I'll ask the second one once you address that.
Okay. So most buyers want a higher cap rate. If you're buying a property, you want a higher cap rate. That means that you're getting more property for the amount you're paying for it. If you're selling a property, you want a lower cap rate. Like you want to sell that property at a lower cap rate because that means that you're getting more money for the same income stream. So I hope that answers that question, but feel free to type in another question if it didn't answer it.
I believe that was a good answer there. The second question here, what is the current cap rate for apartments currently given the market is a little more unsure?
Yeah, so that's a great question. So at this time, what we call it either cap rate compression or cap rate expansion. So when the economy softens, like it's doing right now, there is usually cap rate expansion. And so I think that is playing out in a lot of markets, is that there is cap rate expansion. So buyers are willing to pay less for the same income stream because they're not so sure what's going to happen with the market going forward. You'll see that not a lot of properties are being traded right now because sellers still want to sell at a lower cap rate. So there's this mismatch currently in most markets, I would say, between buyers' expectations and sellers' expectations. And that will eventually correct as people decide they want to sell properties more. I mean, another thing to keep in mind is that we're very underbuilt when it comes to housing in this country. Overall, we are very, very underbuilt. And so that could keep cap rates relatively low just because there is such a high demand for housing. But in general, you're right. Yes, there is a bit of cap rate expansion right now with the softening economy.
And I'll just add 2 pieces of follow-up from the person that posted that first question. I see, who wants to buy a low cap rate with a question mark? So I don't know if that was an actual question or just kind of reiterating the sentiment there. And then the follow-up that they also posted, why would anyone buy a fixed up low cap rate? And then I'll switch to the next slide and we'll keep it moving forward. But there were a few other questions that were not related to cap rates, so we'll cover those later on as well.
Okay, yeah, I think that's a great question. So oftentimes there's investors who they want just a fixed up property that has a fixed income stream, and they're not necessarily trying to grow their wealth quickly. They just want to protect their wealth and still get decent returns, but they don't necessarily want a project. So a lot of times, pension companies, life insurance companies will buy these, we call them stabilized properties that have been totally fixed up and are just producing, say, a 4 or 5% cash flow stream. But a lot of times foreign investors will want to buy these properties. A lot of times family offices will. It just depends on what people's, where they are in their wealth growing journey. For someone like me at my age, I'm in more of the growth stage. I'm looking to accumulate and grow my nest egg, my capital. But at some point, I'll move into more of a capital preservation mode where I'm not necessarily looking to take on more risk. I just want a stable property that I don't have to worry about, and I don't really care that it's not producing the highest returns possible. And that kind of leads into this slide, which it says, if the buyer feels the property contains more risk, they may pay a lower price, which translates to a higher cap rate. We kind of already covered that. But so cap rate is related to risk and a perceived risk. So if you perceive that a property is, let's say you're going into a market and it's a class D property, okay? So their vacancy is high, there's crime at the property, people, it's just not a good vibe when you go there. You kind of feel like a little bit on edge. That's a risky property. I mean, you can palpably feel like, would you want to buy that property? So there's a lot of risk there. It's not to say you can't make good money there if you're successful at turning the property around and, changing the tenant base so that it's more, calm and family oriented and less crime, and it's a place that people want to live. Then you can buy it at a very low basis, at a very high cap rate, and then you can, hopefully sell it at a lower cap rate. So but that's a lot of work, right? Like taking that property from a class D to a class C property is a lot of work and potentially a lot of heartache. Like there might be periods where you're stretched pretty thin because vacancy is really high and because you're trying to change out the tenant base. So there's more risk in that. Now, the types of deals that I like to invest in, or I don't like to invest in the type D deals just because I find that to be too high of a risk for my profile. But there's a middle ground where you invest in a type C property and take it to a C plus or a B minus, or invest in a B minus property and take it to a B plus. So every buyer and investor is going to have their own risk profile. And that's part of what we do in this business is determine, I'm looking for the best returns on a risk adjusted basis. So yeah, I think that pretty much covers that slide. Let's go to the next slide. And feel free to, if there's any other questions, Corey, I can cover those too.
Yeah, there's one more that kind of relates to everything you just mentioned. Are syndications less popular in volatile markets? I think you basically just answered that without answering it, but the description you just gave to my memory or to my thought, pretty much answered that though.
Yeah, I mean, a volatile market, that's an interesting question. Like, what is a volatile market? I mean, I would say Phoenix in 2007, 2008 was a volatile market. Why is that? Well, it was not a very diversified economy. And, prices just went up really high and then they went down really fast, right? And that's single family homes. So volatility in markets is oftentimes associated more with the single family home market. The single family home market, it correlates with the economy much more than commercial real estate. Commercial real estate, meaning apartment buildings, can be much more immune to the swings in the economy. And so you can go into a market like Phoenix and you can still buy a deal with like a relatively decent predictability of outcome. So I think that syndications I actually think that they are less, in terms of kind of the circles that I tend to run in, they're less popular in the stabilized markets because there's less room to really juice the returns. Like if, buying an apartment building in San Francisco or Los Angeles and people there are good deals there, but there's just fewer deals that are going to really produce those kind of outsized returns that we like to see in the circles that I operate in. So hopefully that answered that question.
I believe it did. And there's one other thing relating to that last slide that just popped up. What does risk adjusted basis mean? I think that's a term that you use specifically.
Yeah, risk adjusted basis, it's a term that I use a lot. And what it means is, there's usually this idea that you get more returns, like if you're willing to take more risk. So the more risk you're willing to take, the more you stand to gain. So I think that is true sometimes, but in syndication investing, we're taking quite low risk, in my opinion, relative to say like, the stock market, for example, just speaking in broad terms. So the amount of risk that we're taking is relatively low with syndications. Assuming you do your due diligence and you have a good operator and you like the market and you like the deal, you can really minimize the amount of risk you're taking. And so we're getting good returns on a risk-adjusted basis. So, you know, let's say in venture capital, you might make like 100x on your investment in 2 years, but that's like a very rare situation. The risk of you actually losing money is quite high. In syndications, the risk of losing money is relatively low, so long as you are careful with what you are investing in. It's you can get higher returns relative to the amount of risk you're taking. So that's what risk-adjusted basis means. Are any other questions so far, Corey? Or follow-ups?
Not relative in the moment. There are a few that we'll cover here once once you get the slides back on track. I don't want to distract too much.
Okay, sounds good. Okay, so we're going to talk, I would like everyone, make sure you have your calculators out. We're going to talk about a dollar bill. So how much do you think, like, let's say you find $1 in the parking lot. Would you go around looking around that parking lot for more dollar bills? I'm going to guess the answer is no. Most people aren't going to spend their days going around a parking lot looking for dollar bills. But what if I told you that that dollar bill was actually worth $240? Would you go looking around for more dollar bills? I think the answer is yes, like $240. Well, you know, I would go around looking for more dollar bills if they were actually worth $240. So how is that the case? Next slide, please. So let's take a look at this property. This is an actual property that I own. It's in Washington State. It's a 10-unit property. This was like, you know, this was before we bought it. But in any case, it's a 10-unit property. They're all 1 bedrooms, and it's a Class C apartment. So it's like not that nice, but you know, it's not a bad place either. So we bought it for $735,000, and the amount of equity that was contributed by limited partners was $280,000. Okay, next slide. So let's say we raise the rent on each unit by $1. So $1 times 10 units is $10 per month. $10, and just go ahead and do this with me, 10 times 12 equals $120. So $120 is the amount that the net operating income has increased. Now, as we talked about, the way you calculate cap rate is you take the net operating income and you divide it by the cap rate. So applying a 5% cap rate, so 120 divided by 0.05 equals $2,400. So we just turned that $1 into $240 per unit. So that's why it's $2,400. So the property is now worth $2,400 more than it was before we raised the rent by $1. So guess how much we have raised the rents by in the last 2 years? We've raised the rents by, well, we haven't raised all of the rents in all the units, but we're currently raising the rents by about $500 on all of the rents. So that equals $1.2 million, which is a lot. It's like almost 4 times the amount of the equity that was contributed. So just in a few short years, we're increasing the value just tremendously. It's kind of amazing to see. Now, $500 is kind of a lot. I wouldn't expect in most deals that you would see the rent increase by that much, but sometimes you do get a deal in a market that's just on fire and you do raise the rents that much. And that's how we create this tremendous value. Okay, next slide. So, you know, I kind of already went here, but let's say instead of raising, let's go back. So instead of raising the rent by $1, we raised the rent by $10. If you raise rent just by $10 on each unit, all of a sudden you've created $24,000 of value in the property. So that's $10 times 10 units is $100, times 12 months is $1,200, and then $1,200 divided by 5% is $24,000. So just right there, we've increased the return on equity. We've increased everyone's equity by 8.5%. So just by raising the rent by $10. So that's why improving the efficiency at a property really makes a difference. If you can save on utilities costs, for example, going to energy efficient lighting, or saving on the water, if there's water saving measures you can do, that's another way to really juice the returns. You can also do things like, in addition to just raising rent, you can also create value for tenants by adding reserved parking. A lot of tenants like to know, this is my parking spot, I'm always going to park here, and they're willing to pay for that. At bigger apartments, you can do valet trash because folks don't want to like have to take their trash all the way to the trash. So they just pay $20, $25 a month to have someone pick up their trash. Yeah.
Sorry, I was just going to say another great question that came in that relates to what you're covering right now. Wouldn't you typically have to improve the property to justify the increase? I know a few of the things you're mentioning are about improving efficiencies, but to my knowledge, not necessarily, right? I mean, the property, once you purchase it, could have been significantly below current market rate in that area. I'll let you expand upon that further.
Yeah, that's a good point. So we always talk about two different types of rental increases. There's rental increases that are just bringing the units up to market. So it's called mark to market. There's usually an amount of increase that happens just to bring the units to market. And then there's an additional amount of increase that can happen if you renovate the units. And so those are rental increases due to renovations. The $280,000 of equity that was put into this deal also included a construction budget. And you'll often see that the equity includes a construction budget, or there's other ways that syndicators pay for construction. But to generally answer your question, we do usually break out the projected rental increases. We break it out into mark to market and what we expect will be able to increase the rents by after renovations. And we also renovate the common areas as well. So we do increased lighting, better signage, landscape refresh, just to give us a sense of place, and a place where people feel dignified living, and making it clean and not necessarily flashy, but just clean and nice.
And that person just added, would these strategies be shared to help investors determine whether they want to invest? It's my understanding that's typically part of that PPM or private placement memorandum or prospectus as they're looking into the deal and looking into what you as a general partnership team have planned for the property. Is that correct as well, Suja?
Yes. When we present a deal, we will always discuss the business plan, and we'll say, look, this is how the property is performing right now. And this is what we think we're going to get the property to perform at, based on rental increases and any sort of savings or ancillary income. Ancillary income is those things like, pet fees and things that I mentioned before. So we'll always go over the business plan and talk about why we believe we can achieve the business plan in the time that we've set out. Yeah, so, and I think that is something that investors would want to consider. Some investors would prefer to have deals with a heavier lift so that there's more upside. Some investors would prefer to have deals where, well, there is a bit of personal preference that's involved. And so, we lay all that out so that people can make the best decisions for themselves about where to put their money. Okay, next slide. Okay, so I was just taking this a little bit further. So if instead we increase the rents by $150, then that would equate to $1,500 in extra income per month, which is $18,000 of net operating income per year. And that equates to, I think I got that wrong, it should be $240,000. Okay, let's go to the next slide because I think I got that wrong. Okay, so, but basically where I wanted to end off with the cap rate is that if you're able to make these incremental increases in rental income, it actually has a very tremendous effect on the amount of equity that is increased. So that's the heart of what I wanted to cover. So please feel free to put more questions in. And in the meantime, we're going to just talk a little bit more about net operating income and what that is. So net operating income is income minus expenses. So you've got your rental income, and then you've got your expenses, which includes maintenance, trash, utilities, taxes, insurance, repairs, etc. And so, you know, each apartment building is like its own business. It's collecting income, and then it's got to pay it's got to pay payroll, it's got to pay taxes, etc. And so there's like a delta that is left over. A typical expense ratio is 50%. So, you know, we're always trying to like move that ratio down, but if you're underwriting, a typical expense ratio is 50%, just as a benchmark. So if you guys are looking at deals. Another question is, well, what is an income and expense escalator? And so that means income and expense escalators are projections, right? So when we're modeling out a deal, we're looking at, well, what do we think is going to happen? And we want to be conservative in our projections because as syndicators, it's always our goal to underpromise and overdeliver. And so as a syndicator, it's important to be conservative. And so we have income escalators. What are we projecting that we're going to increase the rent at? You know, some might increase the rent at 3% or 4% or 5%. And it's up to the team to decide, well, what is really a conservative number to increase the rents at? Because we don't want to have rose-colored glasses on. We don't want to be over optimistic. We want to just be realistic about what is actually achievable in the marketplace and on the more conservative side. And same with expenses. You know, we want to model out that expenses are increasing at a realistic rate. Right now, people are bumping up their expense escalators because, you know, things are getting more expensive with inflation. Expenses are going up, and so the expense escalator is increasing. And that's something that we're making sure we're doing to realistically evaluate deals today. And then I'm going to go over the reversion cap rate. So, you know, we just looked at how cap rate can vastly impact the value of a deal. And so when we're making projections as syndicators, we always have to assume a particular cap rate upon sale. And when you change that cap rate at the end, it can drastically change the projections. So we always want to make sure that we're expanding the cap rate, meaning we want to make sure that we're imagining the economy is going to get worse so that we are looking at kind of more of a worst case scenario or a you know, less than ideal scenario. We don't want to assume the economy is going to get better. We want to assume it's getting worse. And that's something to look for whenever you're evaluating deals is what is the projected exit cap rate. Okay, I'm just looking at the time here. We're definitely over. So I think, you know, we've covered a lot, and we've covered a lot of what is at the heart of this. I think I'd like to just go ahead and quickly share the calculator, Corey.
Okay, happy to do that. I'm going to hit change presenter right now. So it should allow you to switch over and get the presentation capacity for the remainder of the session.
Okay, yeah, I'll probably have you take it back over in a little bit. So this is just a really basic calculator that I made that can allow you to project out what will happen if you invest $50,000 a year, and you can change that amount right here. We have an assumed tax rate of 25% that, you know, can be changed as well. So these are the input cells that can be changed. And if you, I'm also assuming a 15% average annual return. Oftentimes our deals are at about 15% IRR. So, and I've taken out the taxes. And, you know, of course, that doesn't really apply for the IRA because everything's tax deferred. But, you know, if you're investing with your personal money, then you are going to have to pay some taxes. And I'm not going to go into the details of that right now. But let's just look at this base case scenario where if you did invest $50,000 in year one, that stream of income would theoretically grow in this way. And then in year two, it would grow in basically 1 year delayed. And here we have like the amounts of equity that you would have accumulated. So after 5 years, you would have $337, assuming that everything performed, you know, at these inputs. But at 15 years, you've got $1.685 million. So, if you're 35 years old and you are thinking about, well, where am I going to be in 50 years when I'm 50 if I invest $50,000? Well, this is the amount that you could, ballpark expect to accumulate by 15 years if you were to invest $50,000 every year. And I just like to have this tool as a planning tool because, if you look at 20 years, you're already at $3 million. I just think it's helpful for actually setting goals, right? Investing goals. We need to have a target for which to work for, towards which to work, but how do you know what to work for? And so this is just a calculator you can play with it. Let's say you have only $25,000 to invest, then the calculator changes and you can see what you'll get. You can also change these individual cells if you have $25,000 now, but then you have $50,000 later. So, and then you can change your tax rate and you can change the assumed annual rate. Like I like to take it down to 8% because that's kind of what the stock market does, and how that changes it. You can see how that will change it. So it's just something to play with as so you can take a look at your own retirement goals and plans. And yeah, so I made that calculator. And again, I think, Corey, now if you want to take back over the screen,
Sure.
we can just go to the ending slide.
Let me just make sure I'm showing the proper screen here.
Oh yeah, it's just the one with, yeah, right here. So yeah, so here is the ending slide. Feel free to please take a snapshot of this so that you can grab time on my calendar. I'm happy to just have coffee on Zoom with any of you to talk through. I know this, you might not end up investing with me, and that's totally fine. But if you just want to talk through what syndication investing might mean for you and your investment portfolio, talk through any other questions that you have. I'm always happy to chat with investors about their goals and questions, because getting comfortable with this is a bit of a process. And, that's what I love doing. I love helping people figure out whether this is the right investment for them or not.
And everyone, just a reminder, you can email Suja for that calculator. She's happy and willing to share it with you. So you don't have to go build it from scratch yourself. She's already done the work there and put that together so that you can prospect your investment outcome after 5, 10, 15 years of investing. So please take advantage of that from her if that's of interest to you. She has been gracious enough to provide you all of this education and information about syndication investing. So don't drop off here and stop looking into it. Continue your due diligence, continue your research, and whatever's going to get you to the next phase of your investing journey.
Awesome. And I know, Corey, that there were some other questions, so I'm happy to continue to have a Q&A session if there's still people on. So if you want to let me know what those questions are, we can do that, and we can end, maybe in 10 minutes or so.
Yeah, I was just going to verify that with you. I'm happy to scroll back up and look through the questions that we did not address in the moment. And to that effect, if anyone has any final questions they'd like to add, we'll be mindful of your time, but also try to make sure everyone's inquiries are addressed. So I'm just going right back up to the top and looking back at the ones that I did not convey to you, Suja, in the moment. One came up. Could you explain sponsor versus general partner? I think just the key term or the verbiage there relative to sponsor versus general partner.
Yeah, so those are actually interchangeable terms. Sometimes we have, that's part of learning the lingo of syndications, is getting a handle on the lexicon, and really those are interchangeable terms.
The next question here, is it a bad idea to be the sole sponsor in a deal?
You mean to be a single person managing all aspects of the deal? I think for smaller deals that can work fine, 10 units to maybe 50 or 75 units at the most. But for the bigger deals, it really just depends on, how much time you have and, who is on your team. Do you have a property manager? So it's not bad, but it's relative, right? Like everything's in the context. So can that person handle it?
And I think that question may have also came in before we delineated what different roles sponsors play. So you actually have a sponsorship team that has a varying level of expertise in different, you brought up 6 different capacities there. So if you're comfortable and you're ready to take on a deal where you know enough about each of those 6 different areas in a smaller deal, then maybe that's a good fit for you. But if not, partnering together with others that have certain expertises, I would say is definitely a worthwhile endeavor to make sure the success of the project is actually at the forefront of the goal and the outcome there. Would you agree, Suja?
Absolutely. Yeah, well said.
Awesome. Next one I see here. In residential real estate, we get to use depreciation carry forward or use it for other income to offset. How does investing in commercial / multifamily real estate with teams like yours help in terms of taxes versus residential real estate? And if there's a capacity of the answer to that question, you would be more comfortable taking offline with that individual, I completely understand that as well. Not trying to get you to overshare or take any personalized questions in front of the audience here.
For sure. Yeah. And I mean, I think that that's anytime we're not offering any sort of personal tax advice, but generally speaking, I can speak generally, we actually have really amazing tax benefits with commercial real estate because we can use what's called cost segregation and accelerated depreciation. So cost segregation allows us to depreciate more of the building than you can in a residential building in year 1 and year 2, year 3, year 4, and year 5. And so you can actually capture a lot of those losses that would take 27 years with residential real estate. You can capture almost all of them or many of them in the first 1 to 5 years. And so all of those losses can be offset. They're passive activity losses. And again, everyone's situation is different, but they're passive activity losses. Those can be used to offset passive activity income. So if you have residential real estate and you're paying taxes on income from your residential real estate, then you would be someone who benefits very much from investing in syndications, most likely.
All right. The next one I'm seeing here, I think it was a tie-in when we were discussing if you'd be looking for a low cap rate to buy and a high cap rate to sell, or vice versa, actually. The sentiment here was good, stabilized assets, period. Are there enough of those buyers out there?
If you mean to sell at a lower cap rate?
I believe that's the context, yes.
Yeah, I mean, I think that's always a good point, is thinking about who the end buyer is going to be. And sometimes the end buyer is going to be another investor. And so sometimes what syndicators do is we leave what we call meat on the bone. So we only renovate, 1 or 2 of the units. Maybe there's 10 units, we maybe only renovate 20 or 30% of them so that the next syndicator can renovate the rest of them. If we think that we want to sell to, if the institutional space, because that's what happens is over time, more and more deals get purchased by institutional investors. So if we think we have a project that an institutional buyer would want to buy, then those institutional buyers oftentimes don't want to do the renovations. And so they're happy to buy stabilized properties. So, we may renovate the whole property and look to sell to an institutional investor. All of that is part of knowing the market and knowing what is happening in the market, who is buying what. And it's going to vary by asset class. It's going to vary by market. So that is part of the expertise that the sponsorship team should have so that they can, really optimize the sale.
Awesome. So aside from a few different people just telling us great job and someone actually asking if this session is recorded, I just want to answer that yes. If you signed up for this webinar and you've participated here today, the session is recorded. You'll receive a copy via email within about 24 hours, and or you could always find it on our YouTube channel, which will be posted in about 24 hours. It will live there in perpetuity moving forward. Someone asked if you and I could get together on a part 2 of your seminar, Suja, so I'm always happy to work and expand a little bit further. I know there's a few slides towards the end that we didn't get to cover, so maybe we could build a second entire presentation for the audience, because it seems like we got some great feedback here. The final statement, it doesn't look like it's worded as a question, but it's something I want to read out to you and let you address or respond to it before we kind of wrap up. Cap rate and strength of the economy may not be the most important or highest correlation factor. It's really about what other options investors have in the interest rate environment. There's a parallel with bond prices and cap rates in that higher rates produce lower prices. Do you have a statement or a response to that statement?
Yeah, I mean, I would say that this presentation was geared more in at sort of a high level, and speaking on general terms. I do think that there's a lot more factors that are at play when sponsors are actually making the decisions about where they, what cap rates they want to purchase at, or what is going into their purchasing decisions. It really also depends on where you can take the property. So, I've been a part of deals where we've bought properties at, maybe a 2.8% cap rate, which is a really low cap rate. But that's because the economy supported in that place, supported a business plan, which we felt very comfortable with. So I think there are a lot more. It's not as simple as you want to buy at a high cap rate and sell at a low cap rate. Certainly, there's many other factors. This is just more of a general overview so that people can start to understand the space.
Awesome. And the real final thing that I'll say here before we close up, someone asked, any current projects available that you can mention briefly? I will kind of just heed that. Advanta, for compliance purposes, is really not allowed to have Suja speak on active deals that she's currently raising for. That is why we have her contact information up here and this QR code that you can schedule time on her calendar and learn more offline in a one-to-one capacity about her current offerings that you may be interested in taking advantage of and joining as a limited partner. So everyone, if you enjoyed Suja's presentation today and want to learn more about how to work with her in Luxe Capital, please reach out to her directly. She'd be, as she said earlier, very happy at any point to have a coffee with you and go over what types of things she's got on her horizon. Suja, anything further, obviously with the compliance side of it, that you'd like to add to that?
Yeah, absolutely. Just with the way we're regulated, we do need to meet with folks before we talk about deals. So please do reach out. I'd love to learn about you and what you've got in mind for your investment portfolio and what you're thinking about, what you're concerned about, and really get to know you and your goals. So that's all.
Awesome. Well, thank you again so much for coordinating this with me, Suja. I really appreciate it. I think we brought some great education and information to our audience. I'm sure you'll get plenty of people following up with you, if not only for the calculator, but also to learn more about what opportunities you have on the horizon. And like someone asked us to do, I'm sure we'll work together and put together another seminar here soon.
Awesome. Thanks so much, Corey. And thank you everyone for coming.